Apple isn't just a tech company, it's a pricing system. And when you understand that, you stop reacting to iPhone headlines like a trader, and you start thinking like an owner. Because the iPhone is a strange product. It's not a basic necessity like electricity. But it also isn't a normal luxury like a handbag. It sits in the middle. It behaves like a luxury utility. That phrase matters because it explains why Apple can take punches that would knock out most consumer electronics companies. Now, most people think the Apple story is a product story. New model good, old model bad. Or China demand up, China demand down. Or AI features, camera features, whatever. But if you're an investor, the Apple story is not primarily a product story. It's a pricing story. It's a margin story. And eventually, it becomes a cycle story. And the one question that matters whenever people start talking about supply chain shocks, tariffs, component shortages, or consumer weakness is the same question that matters in every market cycle. And then what? Let's walk the chain. Start with the first pressure point. Costs. Every physical product lives inside a global supply chain. And global supply chains live inside reality. Tariffs, shipping, currency moves, geopolitical tensions, and the uncomfortable fact that a simple device is a choreography of parts, suppliers, and assembly. Apple itself tells you this in its risk disclosures. It warns that restrictive trade measures can increase cost or limit availability of products and components, that global supply chains can be highly concentrated, and that an escalation of geopolitical tension can cause significant disruption. It even flags that beginning in the second quarter of 2025, new U.S. tariffs were announced, including additional tariffs on imports from multiple countries and regions. So yes, Apple can get hit by costs. But that's not what makes Apple interesting. What makes Apple interesting is what happens next. And then what? When costs rise, a normal company has two bad choices. Option 1, eat the cost. That means margins shrink. And if you're already operating with thin margins, that's not a headwind. That's a wound. Option 2, raise prices. But most companies can't raise prices in consumer electronics because the products are interchangeable. If the customer can switch with one click and lose nothing, your price increase is just an invitation for them to leave. So what is Apple's edge? Apple's edge is that it has more levers. It can raise the sticker price sometimes, sure. But the more powerful lever is something investors often miss because it's not emotional and it's not loud. It's ASP, average selling price. ASP is the quiet lie detector for pricing power. If costs go up and a company's realized selling price holds up or even increases, then the business is telling you something important. Customers are not just buying a device. They are buying preference. They are buying trust. They are buying identity. Now, step back and look at the broader smartphone market. The industry has been trending toward premiumization, where consumers accept higher average prices over time. Counterpoint's forecast had global smartphone ASP rising from about $357 in 2024 to $370 in 2025, with further increases projected beyond that. Apple sits right at the center of that premium zone. But here's the key. Apple doesn't always need to raise price in the obvious way to lift ASP. Sometimes it does it through mix. More Pro models, more storage upgrades, more people choosing the higher tier, more trade-ins that make a higher price feel like a smaller payment, more financing that turns a big number into a monthly number. The customer still walks out with an expensive device. Same category, higher realized price. That is, pricing power wearing a suit. And then what? Now we get to the part that makes the iPhone a luxury utility, the upgrade cycle. Because even with a strong brand, people don't upgrade on command. They upgrade when the upgrade feels worth it, when the old device feels slow, when the battery dies, when the trade-in deal looks good, or when their budget allows it. In good times, people upgrade faster. In tight times, they stretch upgrades. They delay, they make it work, they keep the phone another year. That doesn't mean Apple loses the customer, but it can change the timing of revenue. And timing matters because markets price near-term earnings like they're reality, even when they're just a slice of a longer story. And this is why the upgrade cycle is the swing variable. It's the part that turns a pricing story into an earnings story. Apple can defend ASP. Apple can defend mix. But the upgrade cycle decides the volume and the timing. And then what? Wall Street loves the phrase supercycle. It sounds like destiny. It sounds like certainty. It sounds like a wave you can surf. But real life is messier. Even bullish commentary about a multi-year iPhone upgrade cycle is still just a forecast, because upgrades depend on factors like carrier promotions, replacement behavior, and whether new features feel compelling to consumers. So the owner's question is not, will the upgrade cycle boom next quarter? The owner's question is, if the cycle slows, what happens to earnings and what happens to valuation? And then what? Now let's connect the dots. If costs rise, Apple has to decide where the pressure goes. Does it go into lower margins? Does it go into higher prices? Does it go into mix and ASP? Does it go into product strategy? Does it go into slower demand? The answer is usually some of all of it, changing quarter by quarter. But Apple has a unique advantage. A big part of its value is not contained in the bill of materials. The iPhone is not just a phone. It's the identity layer of a person's digital life. Messages, photos, payments, apps, accessories, family group chats, workflows, habits. The friction of switching isn't just technical, it's emotional and logistical. That's why, when prices rise, many users don't instantly switch brands. They stretch, they finance, they buy last year's model, they choose less storage, they delay the upgrade. But they often stay in the ecosystem. That's what turns luxury into utility. The product becomes embedded, it becomes a default. And then what? This is where investors can make a mistake. They see demand softness and assume the business is broken. They see China headwinds and assume the brand is fading. They see tariffs and assume the margins must collapse. But the correct way to analyze Apple is not to pick one headline and panic. It's to walk the chain. Costs pressure the system. ASP tells you if the brand still has weight. The upgrade cycle tells you how the revenue lands over time. Earnings tell you how resilient the machine is. And valuation tells you what the market is charging you for that resilience. And then what? Now, let's talk about the part most people ignore. Valuation. Because Apple can be a wonderful business and still be a dangerous stock at the wrong price. If rates are higher, multiples become less forgiving. If the market is paying a premium multiple for future earnings, then even a small wobble in the upgrade cycle can cause a large wobble in the stock. Not because Apple suddenly became a bad business, because the discount rate changed, because uncertainty rose, because investors demanded a bigger margin of safety. And then what? This is why Apple is such a clean case study for pricing power. It shows you the difference between a company that sells a product and a company that sells preference. It also shows you why even the best business can't escape macro pressures. Apple itself is explicit that restrictive trade measures and supply chain concentration can increase costs or disrupt availability, and that escalating geopolitical tensions could significantly disrupt global supply chains. That's the world. So the investor's job is not to pretend the world is stable. The investor's job is to decide what kind of business can survive instability without destroying its economics. And Apple, because of brand ecosystem stickiness and pricing architecture, has historically had more tools than most. But More tools is not invincible. It just means the business has room to adapt. And then what? So here's the practical framework you can carry forward, not just for Apple, but for any consumer brand that claims it has pricing power. Ask 3 questions. First, when costs rise, where does the pressure go? Margins, prices, or volume? Second, is ASP supported by real preference or by temporary incentives? Third, if the upgrade cycle stretches, does the business still compound, or does it depend on constant replacement to survive? Because the moment a business depends on perfect conditions, it's not a moat, it's a mood. And the market does not reward moods for long. Apple's iPhone, this luxury utility, shows you what real pricing power looks like. Not loud, not emotional, but structural. And the final lesson is the one investors hate, because it forces discipline. A great business is not the same thing as a great purchase. The difference is the price you pay. And if you can keep your eyes on the chain, costs to ASP to upgrade cycle to earnings to valuation, then you can stop trading headlines and start thinking like a long-term owner. And when the next shock hits, you'll already know what to ask. And then what? Educational content only, not financial advice.